Good morning and welcome to the latest edition of EMI's What's Up Monday for the week beginning March 26th. This is Dominic Chiricello and I'll be with you for this presentation. And remember, as always, you can contact me at my email address at dchiricello@emi.org. I'll show it again at the end of the presentation, or you can go to our website at www.emi.org and also find contact information at that stage of the game. If you're on a trial and you want to subscribe, you can see our link down below that you can log into, and you'll see that link also on our website in order to be able to subscribe. I hope you've been enjoying the discussions here on a weekly basis, and most importantly, I hope you've been profitable and enjoying a really volatile and uncertain market that we've been seeing here over the last several weeks in particular. So with that, let's get started and let's talk about some of the highlights from last week and where we're heading for this current trading week. So what are we going to talk about today? I mean, obviously we've got to start off about the global uncertainty and the really above normal level of volatility in most of the commodities and financial markets over the last week, and I don't anticipate that changing as we head into this new trading week. But we'll get into that in a little bit more detail. We'll take a look at the price direction and some snapshots and some of the key spreads in the oil complex. We'll talk about interest rates. What that impact from last week's U.S. central bank's increase in the short-term interest rate and the impact it's had on the dollar, the direction of the dollar, and obviously subsequent impact on the price of oil. Fundamentals are continuing to change. We'll talk about that. Last week was a positive week. We saw the EIA's weekly inventory snapshot show a pretty strong decline in total inventories last week, with all of the major commodities within the complex also showing a decline in inventories. We'll talk a little bit about where we expect inventories this week. We'll bring an update as to what's going on with OPEC and highlight some of the main economic events that will definitely contribute to the global uncertainty and add to the volatility that exists in the market. So when we talk about global uncertainty and volatility, last week, we saw a continuation of a change in strategy by the United States. The United States has been relatively low key over the last 10 years or so, insofar as protecting its so-called protecting its turf. President Trump, a couple of weeks ago, put in place the potential for a 25% tariff on steel and aluminum. And this past week, he signed a directional tariff imposition on about $60 billion worth of China's imports. And obviously the market has gone relatively in the direction of, wow, this is the beginning of a major turf war, a tariff war, and trade war, and the end of the global economy growth is over. I don't think so. I mean, this is just me speaking, my opinion. I think this is a negotiating strategy, and we're seeing it already on the aluminum and steel side. And as of this morning, we've actually already seen the U.S. and China actually sitting down and seeing if they could very nicely resolve some of these issues and all. And even the magnitude of what these tariffs are certainly not substantial enough to really derail the economic growth we've seen so far. I don't think there'll be a tariff war, trade war. I think this is a negotiating strategy, albeit very unconventional for the United States, but be as it may, it is a strategy, and we'll see how this evolves. But as it's evolving, it's going to create a whole lot of uncertainty. It's going to cause markets to change direction on a dime, and that includes oil. So we need to be cognizant of the 30-second sound bites that are floating around the media airwaves all day long regarding this topic. Geopolitics is certainly something that's growing and adding to the uncertainty. Just yesterday, the Saudis, in their proxy war with Iran in Yemen, launched seven ballistic missiles at Iran's backed Houthi militia, and basically we'll see, or I should say, the Saudis' defense knocked it down from this militia, and the direction of some of these missiles were basically towards the Saudi target, Saudi capital of Riyadh. So again, nothing is slowing down here in the Middle East, and obviously geopolitics will continue to support the price of oil much more directionally as global inventories continue to decline. There's also a growing view that the U.S. may not roll over on the Iranian nuclear deal, and that certainly has implications for supply coming out of the region. So we haven't really been paying a lot of attention to geopolitics over the last 3, 4, 5 years as the world was sitting with a huge surplus of oil. But as that surplus is diminishing, as the inventories are getting back down to much more normal levels, we need to watch this. Again, this is something that could change the short-term direction, even the long-term direction of the market very, very, very quickly. Inflation has also been a concern that's adding to the global uncertainty. The U.S. Central Bank raised short-term interest rates by 25 basis points, or 1/4% last week, although the central bank chairman Powell indicated that inflation is not out of control. Inflation is not something that we need to become real aggressive on. So I think the market's kind of becoming a little bit more relaxed with the whole concept of the Fed raising interest rates. They're probably going to raise them at least another 2 or 3 times this year and next year. But at the end of the day, even raising interest rates, we're still sitting with relatively low rates here in the United States. We're entering a period globally where the world that has been on a quantitative easing program since the financial markets collapsed in 2008. That's changing now, and what we're starting to see is these markets, these economies, starting to clean up their balance sheet and change some of that. So it's not a catastrophic, very, very aggressive change, but it's a change, and markets also get very uncertain whenever there's any kind of change. Also last week, we saw a huge spending bill of $1.3 trillion approved in the United States to shore up, in particular, the military, among other things. We'll have to see how that evolves and how that implicates and impacts the global economy going down. And last week, we had the largest decline in U.S. equities and many other equities in months and months. And it was just a meltdown. And but what we're seeing is a little bit of a recovery. We're seeing some profit taking, some short covering right now this morning. Whether this is a change, whether we're putting in a bottom at the moment, too early to say in the trading week since it really just started. But at least we're starting out on a positive note. We've seen some upticks in international equities, and that's supportive for the price of oil. Although oil is kind of hovering around unchanged here this morning so far at around 8 a.m. Eastern time, and we've also seen the dollars declining a bit this morning. It's off about the U.S. dollar index, which is against a basket of 7 currencies, is down a little bit, about a quarter of a percentage point. Going forward. So I hope you enjoyed the update, and I hope this is a product that you'd be interested in entering into a subscription, again, you can email me with any questions or comments. This is Dominic Chiricella at dchiricella at emi.org, or you can go to our website at www.emi.org, and then you'll find many ways to subscribe and extend this trial. Again, good luck trading this week. It's going to be a volatile week. I would strongly suggest you keep your seatbelts on. And again, I would strongly suggest you focus more on the risk side of your trades and let the reward side play out on its own. It's the risk that we need to protect against this week, again, because of the uncertainty and because of the overall volatility, or the above normal level of volatility. Again, thank you very much for listening, and we'll see you again next week.